Hello everyone, this is Andrew McNair from SWAN Capital with our June 2022 SWAN Report. In this month's video, we're going to discuss the recent headlines that are influencing the financial markets. But I also want to provide you some perspective on what these developments may mean for you over the next few months ahead. Now, as always, please stay tuned at the end of this video for a required disclosure statement. Now, at SWAN Capital, our market outlook is remaining cautious. And we've talked about being cautious during a period like this because of inflation as well as the rising interest rate environment we find ourselves in. And I want to share with you some other people's opinions, such as Jamie Dimon, the CEO of JP Morgan Chase, who revised his review of the economy this month. He had earlier stated that there were storm clouds out on the horizon for the economy. And his weather forecast sadly has changed for the worst. Now he is saying that we are to expect a hurricane. Dimon specifically cited the Fed's desire to unwind its balance sheet, and its inexperience with financial tightening is the reason that he lacks confidence in their ability to pull off a soft landing. Now, a soft landing is what Fed Jerome Powell has been hoping for, that they can raise interest rates, lower inflation, and that they will keep the economy from stalling out and putting us into a deep recession. Well, the $9 trillion balance sheet that the Fed has accumulated has to be mopped up, and the impact that it has on interest rates long term will be severe. Another person's opinion, the Tesla CEO, Elon Musk, who has stated that he has a super bad feeling about the economy and laid out plans to lay off 10,000 workers. That's right, 10,000 workers. Yes, this is just two people's opinions, but they are high-profile business leaders. And their lack of optimism isn't encouraging for markets. So given Dimon's as well as Musk's access and insight into the real-time business climate of America, it's really much deep-seated outlook that we think this bear market is not going to go away very quickly, that it could last 12 to 18 months. The stock and bond markets have been stuck in a negative trend in 2022. We've seen losses in bonds as well as stocks. And it's for a combination of factors. It's first and foremost the Russia-Ukraine conflict that's not over with. Actions from the Federal Reserve, surging inflation, and various spots of weakness that we see in the U.S. economy. And it's entirely possible, again, that this nasty ride in the market could last longer than we all could like. And that's why at SWAN Capital, we have been proactively preparing over the last several months for a time such as this. Specifically, here's what we've done to protect our clients from this bear market. First is tactical investing. In markets like this, tactical investing works better than passive investing. We've moved clients' portfolio toward a higher position in equities and have been getting in the process of getting rid of bonds, long-term and short-term bonds that are sadly losing in value as well. We want to be hands-on with investing when the market enters a correction like this. Then we also have number two, Roth conversions. When the markets drop, it's a great time to call your CPA and financial advisor to discuss a Roth IRA conversion. By processing a Roth IRA conversion for our clients during a downturn like this, we have now positioned their Roth for success. See, if you move a portion of your depleted IRA account value over to your Roth IRA, buying the same positions, you have now primed the spring so that once the market returns and the spring is released, you have the potential for a huge tax-free recovery. Lastly, we've also invested some of our clients' cash in the market. We're encouraging clients that have had money on the sidelines in checking accounts and money markets. It's a perfect time to get that lazy money to work and take that money and dollar cost average into the market, hoping that if we're very diversified, we'll see a recovery to come. We still have a healthy cash balance that we will be continuing to use for future market downturns. Now, if you're finding yourself overly anxious about what's going on in the world, remember, it's never as bad as it seems. It's also never as good as it seems. But drops in the market happen. It's just been a while, and this is why we do what we do. In response to a market decline, is what matters the most of what we do when we have market declines. This is our opportunity. When the market declines, volatility rises, it's time to take action. And at SWAN Capital, we're on top of this. This is when we shine the most, when it absolutely counts. Now let's turn our attention to the Federal Reserve as well as inflation. The Consumer Price Index, CPI, climbed back to 8.6% after dipping to 8.3% in May. That's setting a new 40-year high. The previous recent high was 8.5%, which was in March. So much for peaking inflation or transitory inflation. It seems, sadly, that we're headed in the wrong direction. Prior to the data coming out, markets were working on the hope that inflation was on the downward trend, and the Federal Reserve would potentially have an excuse to stop raising rates in September. All this hope seems misguided, as the Fed has merely said it would reevaluate its approach when so far it has only raised interest rates by 0.75% and currently plans to raise another 1%. The market was supposed to have all of this priced in. At least we thought so, right? Now the market is predicting another hike of 50 basis points or 0.5% as its September meeting comes along. There's no meeting in August, so September meeting is where we'll really keep an eye on to see if they pause. But I want to share with you our mathematical solution as to how much more the Fed needs to raise. This is how the formula should work. If inflation remains above 8.5%, and we've already been committed to raising the Fed funds rate to 1.75%, plus targeting 2% inflation, to truly fight inflation, the Fed needs to raise interest rates by 4.75%. It currently looks like the market hasn't factored in anything close to that. And to make matters worse, both the 2-year and the 5-year Treasury curves have inverted with the 10-year Treasury note last week. So what does that mean? This means that near-term maturity bonds have a higher yield than longer bonds maturities, which signals less confidence in the economy going forward, a further sign of trouble for the U.S. economy. The housing market is also stumbling, and that's what I want to turn your gaze to, is the housing market. It is still red hot in the housing market, but it appears that there may be trouble lurking ahead. For example, the 30-year fixed rate has doubled to 5.6% from 2.75% last fall. Applications for mortgages of new homes fell by 7% earlier this month, 21% lower than the same week last year. With mortgage rates marching higher, it has no surprise that refinance demand has also dropped 6%. That's down 75% year over year. The market still is red hot, but there's little inventory and a lot of demand. However, people are being priced out due to both higher asking prices and rising interest rates. So focusing on the housing number is very important due to the ripple effect that the housing market has long-term on our economy. Just think about all the Home Depot visits, to appliances, to electronics and furniture sold, and remodeling projects that go along with home ownership. See, a slowdown in housing is on the way, and with the current state of the economy, it will not be welcomed at all. That's going to be it for this month's SWAN Report. I want to thank you for listening to our SWAN Report every month. Now remember that this is not personal advice to you. And how could it be? Because we're not meeting one-on-one. But if you have questions about your personal situation, about your portfolio, don't hesitate to give us a call at 850-380-9558. That's 850-380-9558. We look forward to seeing you next month.